Congratulations, you've made it to the last video for Accounting 325. This is video M20B on firm valuation. So before you get started on this video, you should have noticed that there was a Word document posted with this video. You should probably have that handy. There's also an Excel template, so you may want to get that open and ready because we're going to need both of those things to do a few calculations before we're done. All right, it's the last one. Let's get going. Financial ratios are used as measures of financial health for firms. There are two primary types: ratios that measure the liquidity of the firm and ratios that measure the profitability of the firm. So here are some liquidity ratios. Accounts receivable turnover, which is sales divided by average accounts receivable. Inventory turnover, which is cost of sales divided by average inventory. The current ratio, which is current assets over current liabilities, which speaks to a firm's ability to cover its current liabilities. But then even tighter is the quick ratio, a little typo in there, which is only cash and AR divided by current liabilities. There's the cash flow ratio, which is cash flow from operations divided by current liabilities, and free cash flow, which is free cash flow divided by current liabilities. So just so you know, free cash flow is cash flow from operations minus any capital expenditures and minus any dividends. The profitability ratios are the gross margin percentage, which is gross profit divided by sales. Return on assets, which is net income over average assets. Return on equity, net income over average shareholders' equity. And earnings per share, which is net income divided by the weighted average shares outstanding. Okay, we're going to go calculate some of these ratios for practice. So pull up that Word document that was posted in this part of Blackboard with the video. And you may also want to pull up the Excel template that we're going to work with. So I'll see you over in Excel in a second. Okay, welcome to Excel. We're going to calculate some of these ratios now using the balance sheet and income statement information on our example company that is posted and waiting for you in the Word doc in Blackboard. Okay, so we need to start with the accounts receivable turnover. That's going to be sales, which is $3.5 million, divided by average accounts receivable. So average accounts receivable is going to be 150,000 plus 225,000, and of course we want to divide that by 2. All right, next we can go on to inventory turnover. So inventory turnover is cost of sales divided by average inventory. This time I'm going to get it right from the get-go. 385 plus 175 divided by 2. Okay. The current ratio is simply the current assets, which are listed as 795,000, divided by current liabilities, which is 200,000. The quick ratio is cash, so cash pretty straightforward, 260,000, and AR, divided by current liabilities. There we go. All right, then I got the cash flow ratio. That's the cash flow from operations. So we have that amount. It is provided to us divided by current liabilities. Then we have free cash flow. Now, free cash flow is a little more work, so we're going to have to back into that number. So we're going to start with cash flow from operations. Well, what we have to do is get rid of the capital expenditures And we also have to get rid of any dividends. So it turns out capital expenditures are down in the second table of 200,000 and dividends are 50,000 divided by current liabilities. So these measures speak to our ability to cover our liabilities, right? So accounts receivable turnover speaks to how quickly our accounts receivable is converting into sales. Inventory turnover is how quickly inventory is being sold and converted into cost of sales. The current quick cash flow and free cash flow ratio all measure our ability to cover current liabilities. So we certainly have enough current assets to cover them. We certainly have enough cash and accounts receivable to cover them. The cash flow ratio speaks pretty solidly to that. But our free cash flow, well, that's a little bit troubling because we couldn't really cover our current liabilities once we had paid off the capital expenditures and dividends that we had available to us. All right, now let's look at some of the profitability ratios. So the gross profit is $1 million. We need to divide that by sales. We'll cheat a little bit. Drop that in. All right. Net income divided by average assets. So we need to get the average asset balances off the balance sheet. Pardon me while I pull that up while you're working on it too. Plus 2035 divided by 2. There we go. All right, return on equity, net income divided by average shareholders' equity. And last but not least, earnings per share. All right, so for that, I need to get my weighted average shares outstanding. Oh, and it was the same in both periods. That makes that easy. Got one too many zero there. There we go. All right. So there's our profitability ratios. Pretty straightforward, pretty easy to calculate. Okay, I will also post the solution to this. It's in Blackboard. Hopefully you didn't see it until you went looking for it. All right, back to PowerPoint. So another way to measure the performance of a particular business unit is through something known as economic value added. So EVA is a business unit's income after deducting taxes and after deducting the cost of capital. So the idea is that EVA approximates a firm's economic profits. Now, EVA requires adjustments to financial accounting data to correct for what they would call accounting distortions. EVA focuses the manager's attention on creating value for shareholders by earning higher profits than the firm's cost of capital. The firm increases its internal resources available for dividends and or to finance its continued growth. EVA is an indirect measure of stock return that is useful when stock prices aren't available. So now we're going to shift gears and talk about business valuation. So business valuation examines the value of a company so that you can come up with a dollar amount that represents the company's worth. And there's a couple ways you can approach business valuation. The first is from the viewpoint of the owner, shareholder, or interested investor. That is, what is the value of the firm's shareholders' equity? However, from the viewpoint of a potential buyer, it's what would one pay to purchase the entire company? That's debt, equity, and all the assets. So there are 4 basic valuation methods. The first is the book value method. That's the quickest and the easiest method, and it's equivalent to the value that appears on the balance sheet for stockholders' equity. The market value method is the market value of the firm's common equity, And that's generally directly from the current market value of the firm's shares. And you hear that term in the business news a lot as market cap. The discounted cash flow method, which we've done some discounted cash flows, basically measures the firm's equity value as the discounted present value of its estimated future cash flows. And a multiples-based approach uses a ratio of stock price to some financial measure to determine the value of the firm's equity by comparing it to other firms that are similar, for example, in the same industry. So again, book value equals the book value of equity. This is typically the par value of the common plus any additional paid-in capital plus retained earnings. And one of the weaknesses is this is all stated at book value and doesn't represent the fair market value. That's why sometimes we use the market value of equity, simply the shares outstanding times the market price. That's why it's called market cap. So this is a very easy to measure to get if there is a market for the stock. If it's not publicly traded, there's often not a market. Therefore, you got to resort to some other methods, something like the discounted cash flows method, where we take the present value of all the cash flows. And cash flows can be measured a number of ways, and the textbook espouses using free cash flows. Present value of cash flows represents the future value, but the firm has current value also, and so we also need to add in any liquid investments and then subtract any long-term debt from that value. And I can tell you there are many, many versions of the discounted cash flow model. For example, one of them you see frequently is the dividend discount model. The multiples method uses industry or benchmark ratios of similar firms to target so that you can back into the price. So for example, the earnings multiplier, you might determine that the industry average of price to earnings is 8.5. And so you can take this specific firm's earnings and multiply it by 8.5 and get an estimate of its value. So what you would pay for a business is often called its enterprise value. And that's typically the market capitalization plus any debt, less any cash. Okay, let's go back out to Excel and using the same data, do some valuation calculations. All right, we can start with a book value of estimate that comes right off the balance sheet as shareholders' equity. If we wanted to consider the market value, then what we need to do is how many shares are outstanding, and we need to multiply that by the market price. There we go. The discounted cash flow is a little more complicated. That's our free cash flows. And we're just going to assume that those free cash flows are going to persist into the future. And that's something called a perpetuity. But we can calculate the present value of that perpetuity by multiplying that cash flow times 1 divided by the discount rate, which we're going to assume is 5%. And eventually, I'm going to remember to do that. So recall that the enterprise value is the market value plus any long-term debt minus any minus any cash on hand. Okay, so if we're going to use a few multiples based, then we need to know what some of these ratios are. Those are provided in the information that's given, again, down in toward the bottom of the second table. So we can see that the sales multiplier is 1.5%. So we can simply take the sales amount multiply that by 1.5 and get the sales base multiplier. The free cash flow says that's free cash flow times the multiplier, which is listed as 18. And then lastly, the earnings multiplier is simply our earnings times 9. Okay, and that's all there is to it. Those are a variety of methods by which you can calculate firm valuation. Now we can see we have quite a bit of variability in our numbers. And so we're going to have to try to take these and do some deeper analysis to get to a true valuation. But for this course and for a good starting point, this is a great place to start. All right, let's head back to PowerPoint and finish up. And that is the end of video M20B and the end of the videos in Accounting 325. I certainly hope you've enjoyed watching them. Well, okay, maybe not enjoyed, but hopefully they've been helpful in some way to get you through. It's been a long 8 modules. I know you guys have worked hard. We're almost done. A little bit of homework, a little bit of quiz, a little bit of final exam. Okay, not a little bit. And then we're home free and you're done. So I appreciate all your attention all semester long. I hope you've enjoyed the class. Look forward to seeing you some point in the future. Thanks a lot.
Learn it, know it, live it.
Throwing this body in, it's going to fall for Ibrahimovic.
My name is Rex, and if you study with my 8-week program, you will learn a system of self-defense that I developed over 2 seasons of fighting in the octagon. It's called Rex Kwando.
Uno, Nicolay.
Hey, you guys had shirts on when you came in here.
Something happened to him, man.
Come on, Spicoli, just put the shirts back on. You see that sign?
No shirt, no shoes, no dice.
Right. Learn it, know it, live it.
Well,
We're all in strung out shape. But stay frosty and alert. We can't afford to let one of those bastards in here.
All right. Oh,